Sir, very happy morning to all. We are doing math. In that, we have done the normal math question. That means we have studied and analyzed the format of the math. Net profit as per P&L account. Add items covered under explanation 1 to 115 JB subsection 2. That is IRS will get depreciated. Income tax paid or payable, reserves created by whatever name called, set aside for unascertained liability. Then dividend paid or payable, diminution in the value of asset, depreciation, deferred tax, expenditure incurred under section 10, 11, 12, expenditure incurred by a foreign company on account of IFRS and capital gain. IFRS stands for interest, fees for professional or technical services, royalty or any other similar sum. And after that, any expenditure incurred from AOP or BOI covered under section 86, or any expenditure incurred to earn royalty income covered under section 115 BBF. Then provision for loss of subsidiary debited to P&L account. You will get the subtotal. Less you have to reduce the tired. T stands for tonnage tax income. I stands for income covered under section 10, 11, 12. Income earned by a foreign company on account of IFRS and capital gain. Income earned from AOP or BOI covered under section 86 and income earned from royalty covered under section 115 BBF. Then reserves withdrawn. In that two reserves are there. One is normal reserve and other is revaluation reserve. With regard to the normal reserve, you have to just only check that in the year of creation have we added back or not. With regard to the revaluation reserve, sir, if a good company, they will withdraw from the revaluation reserve to the extent of depreciation that is provided. If you are withdrawing less than that, then automatically that fraud adjustment will be caught by the MAT format. If you are withdrawing exactly the same, then the MAT format becomes redundant, useless, because the same amount you will add back and you will be reducing 2 times. But if you are withdrawing more than the amount of depreciation, then my dear lovable students, you will be reducing only to the extent of depreciation on account of revaluation. Fantastic to the core, sir. Then we are having, after reserves withdrawn, sir, T, tonnage tax income, reserves withdrawn, and depreciation excluding revaluation. Actually, these two are same point. And the last one is deferred tax. Brought forward business loss or unabsorbed depreciation or unabsorbed depreciation based upon the nature of the company. Whichever is lower can be claimed it as a deduction. Then, my dear lovable students, you will automatically get the book profit under 115J. Now, today in this slot, we are going to talk about a company for whom the Ind AS, in financial reporting, you would have heard about Ind AS. So, for a company, if Ind AS is applicable, that's what introduction of MAT we have done. Now, MAT for Ind AS company. So, what they are saying, for Ind AS company, some special Ind AS adjustments will be there. How to calculate the MAT for that Ind AS company is what our discussion is all about. So, section 115 JB subsection 1 only we have discussed. In this 1 and 2 only we have discussed. In this slot we are going to talk about 115 JB subsection 2A, 2B and 2C. These are the 3 sections applicable to MAT for Ind AS company. Because there the general adjustment for a normal company 115 JB subsection 2. Adoda subclassification da MAT for Ind AS company, which is 115 JB subsection 2A, 115 JB subsection 2B and 115 JB subsection 2C. Solunga, 115 JB subsection 2A, 115 JB subsection 2B and 115 JB subsection 2C. Repeat once again. 115 JB subsection 2A, 115 JB subsection 2B, 115 JB subsection 2C. In that, my dear lovable students, computation of book profit for Ind AS compliant company. Is your company liable to comply with Ind AS? Then the book profit computation under 115 JB will change. adjustment in the book profit due to adoption of Ind AS. There are two types of adjustments are there. Number one, annual adjustment, and other is transitional adjustment. One is annual adjustment, that means year by year adjust பண்ண வேண்டியது. Then transitional adjustment. Transitional adjustment in the sense means earlier I would have followed the accounting standard, but immediately when I start following the Ind AS, there will be some differences in so many values. So those differences I will park in separate account and I will write off over a period of 5 years. That's what transitional adjustment. So if it is annual adjustment, 115 JB subsection 2A and 115 JB subsection 2B. I already said that 3 sections are ruling Ind AS. Ind AS company 3 sections are ruling. 115 JB subsection 2A, 115 JB subsection 2B and 115 JB subsection 2C. Adila 115 JB subsection 2A and 115 JB subsection 2B is talking about annual adjustment. Varsha varsham panna vendiya adjustment. Whereas 115 JB subsection 2C is traditional adjustment on convergence rate. That means on the date of convergence between the normal AS and the Ind AS, there will be lot of difference between various accounts that will be taken care by 115 JB subsection 2C. Fantastic to the core. Now we are starting one by one in detail. For a company whose financial statements are drawn up in compliance with Indian accounting standards, that is Ind AS, book profit as computed in explanation 1 to section subsection 2 shall further. That means what we have learned is 115 JB subsection 2, that has to be further adjusted with 1, 2, 3, 4. 4 more adjustments you have done, then only their book profit you will get. That means நம்ம படிச்சது எதுவுமே குப்பையில போட வேண்டிய அவசியம் இல்லை. How we have find out the book profit under 115 JB subsection 2, அது அங்கேயே நிக்கட்டும். நம்ம அங்க ஒரு book profit reach பண்ணோம் இல்லையா, the same book profit அது கூட we have to make 4 adjustment. Number 1, you have to increase, you have to decrease, you have to increase, you have to decrease. That means ஒரு ஐட்டம் நீங்க ஆட் பண்ணணும், the corresponding ஐட்டத்தை நீங்க லெஸ் பண்ணணும். ஒரு ஐட்டம் நீங்க ஆட் பண்ணணும், corresponding item P&L அக்கவுண்ட்ல இருந்தா லெஸ் பண்ணணும். நம்பர் 1, increased by all amounts credited to OCI, that is other comprehensive income. அப்ப other comprehensive incomeல ஏதாவது OCI அக்கவுண்ட்ல, it's a new term, OCI அக்கவுண்ட்ல ஏதாவது கிரெடிட் பண்ணியிருந்தா that has to be added back, because நீங்க P&L அக்கவுண்ட டெபிட் பண்ணியிருப்பீங்க, OCI அக்கவுண்ட கிரெடிட் பண்ணியிருப்பீங்க. The journal entry you would have passed as P&L account debtor to OCI account. P&L account debtor to OCI account. So because of debiting the P&L account, the net profit, ideally the book profit as per the P&L account will come down. You should not allow that P&L account to come down. So that item should be added back. So increased by na நம்ம என்ன பண்ணணும், add பண்ணணும். By all amount credited to OCI in the statement of P&L, under that item will not be reclassified to P&L. So in the profit and loss account, 2 category of items will be there. Items that will be reclassified to P&L, that means future la adu P&L account ku varum, and item will not be reclassified to P&L, future la and item P&L account ke varadu. Item that will be reclassified to P&L, automatically அது P&L accountல வர்றதுனால it's only a timing difference. அதை நீ மேட்ல adjust பண்ண வேண்டிய அவசியம் இல்லை, because automatically P&L accountோட credit sideலையோ debit sideலையோ future yearsல வரும். அப்ப automatically net profit increase ஆயிடும், அப்ப automatically book profit increase ஆயிடும். But item that will not be reclassified to P&L, my dear lovable students, அந்த ஐட்டம் இப்போ விட்டோம்னா அப்புறம் அதை டாக்ஸ் பண்றதுக்கு வாய்ப்பே இல்லை. So if you are debiting any item to P&L and crediting any item to OCI, that is other comprehensive income, and if that is a category of item which cannot be reclassified to P&L, don't leave it, make the adjustment. Or the counter, decreased by, we have to reduce. by all the amount debited to OCI. Debited to OCI means credited to P&L. So you have debited the OCI account and credited the P&L account. So what is the journal entry you will pass? OCI account data to P&L account. So in P&L account by OCI account. So because of crediting the P&L, my dear lovable students, my net profit would have been increased. If the net profit increased, on that increased net profit, you are liable to pay what? Tax, MAT. Don't pay it. Why are you paying? In the statement of P&L under the head, item that will not be reclassified to P&L. I already highlighted that only the item that will not be reclassified to P&L taken adjustments. So in P&L, two category of items will be there. Item reclassified to P&L, ignore when you are doing the MAT. Item not reclassified to P&L, my dear lovable students. Item not reclassified to P&L, if you are debiting to P&L account or crediting to P&L account, you have to add back or you have to reduce as the case may be. This is the adjustment number 1. Number 2, again increased by the next item. Amount or aggregate of amount debited to statement of P&L. Unnecessarily, if you are debiting this item to the P&L, should be added back. On distribution of non-cash asset to the shareholder, to the shareholders of the company, if you are distributing non-cash assets in a demerger in accordance with the Appendix A of Ind AS 10, because of Ind AS 10, my dear lovable students, if you are distributing non-cash item to the shareholders at the time of demerger, that is, there was a big company, you are demerging the company in order to settle the shareholders of the resulting company. The demerged company is issuing non-cash item, and that non-cash item you have debited to P&L account. What government of India is saying that when you are calculating the MAT, that debit should be added back. So that demerger adjustment we will not allow. So sometimes I would have settled more for the purpose of demerger, so that extra amount I would have debited to P&L account, that is not allowed. Or I would have settled less at the time of demerger, that amount I will credit to my P&L account. So decreased by all the amount or aggregate of amount credited to statement of P&L on distribution of non-cash item to shareholder in a demerger in accordance with the Appendix A of Ind AS number 10. Brilliant to the core. So only two adjustment, my dear lovable students. Ind AS means 3 sections are there. 115 JB subsection 2A, 115 JB subsection 2B and 115 JB subsection 2C. Repeat, 115 JB subsection 2A, 115 JB subsection 2B, 115 JB subsection 2C. Adila meena number 1 OCI adjustments, OCI adjustment. Number 2 demerger adjustment. Sir, if any item debited to P&L account and credited to OCI account should be added back. Any item, sir, debited to OCI account and credited to P&L account should be reduced. Brilliant. As per Ind AS number 10, if you settle any non-cash item to the shareholders at the time of demerger and that has been debited to P&L account should be added back. Sir, because of lower settlement to the shareholders at the time of demerger, if that amount has been credited to P&L account, my dear lovable students, then that amount should be reduced from the P&L account. So we are going to do the provisions in detail, in depth. According to 115 JB subsection 2A, I already said that 3 sections are there. 115 JB subsection 2A, 115 JB subsection 2B, 115 JB subsection 2C. Are you getting? For a company whose financial statements are drawn up in compliance to the Ind AS, book profit as computed in accordance with 115 JB subsection 2 shall be further. Number 1, increased or decreased by all the amount credited or debited to OCI in the statement of P&L under the head income that will not be reclassified to P&L account. So there will be two category of items will be there. Income that will be reclassified to P&L and income that will not be reclassified to P&L. If the income is reclassified to P&L, now leave it, my dear lovable students. Income reclassified to P&L, leave it. Because anyway, automatically over a period of time, it will get adjusted. Whereas income not reclassified to P&L, caught it. Now you have to tax it, otherwise you will lose the tax. Next one, increased or decreased by the amount or aggregate of amount debited or credited to the statement of P&L on distribution of non-cash item to the shareholder in a demerger in accordance with Appendix A of the Ind AS number 10. That means at the time of demerger, you are either settling more to the shareholders or less to the shareholder by way of issue of non-cash asset. If that item has been debited to P&L account or credited to P&L account as per Ind AS number 10, then that adjustment will not be allowed as per Ind AS MAT, should be added back or reduced. It may be noted that further they are talking something. The following amount reflecting under the head item that will not be reclassified to P&L shall not be increased or decreased from the book profit. So what is our understanding? Items classified into two category. Number one, items reclassified to P&L, items not to be reclassified to P&L, right? What is the rule? Any item which is reclassified to P&L, don't adjust it. Why are you adjusting? Because anyway it will become form part of the P&L account in future. But item not form part of NSR P&L, which will not be reclassified to P&L, if you lose now the chance, you won't get the chance. So we have to adjust it. But it is having exception. There are two exceptions to that. Revaluation surplus in accordance with Ind AS 16 and Ind AS 38. As per Ind AS 16 or Ind AS 38, my dear lovable students, as per Ind AS 16 or Ind AS 38, if you revaluation surplus on asset, for example, 1 lakh rupees is the book value of the asset, you have increased to 3 lakh or 4 lakh. That means, my dear lovable students, you have revalued. That revaluation surplus, you don't adjust now. Number two, gain or loss from investment in equity instrument designated at fair value through OCI in accordance with Ind AS 109. So I have invested somewhere and I have brought that investment to the fair value, designated at fair value. Because of that, I am getting some gain or loss as per Ind AS 109. Don't do anything with regard to the MAT. So when this will be adjusted, question arises, how are the book profit of the previous year in which the asset or investment referred above is retired, or disposed or realized or otherwise transferred shall be increased or decreased as the case may be, the amount or the aggregate of amount referred to above for the previous year or any of the previous year and relatable to such asset or investment. That means in that OCI, what we have learned is item that will not be reclassified to P&L. Item that will not be reclassified to P&L has to be adjusted. But it is having two exceptions. Number one, revaluation surplus, because it's only a notional entry, book entry. As per Ind AS 16 or Ind AS 38, you would have made some notional profit in the books of accounts. If you are creating any notional profit, what government is saying that don't pay MAT on that. Number two, my dear lovable students, you have invested in some company, you have brought that investment to the fair market value, so designated at fair market value. Because of that, you have booked some gain or loss. Again, this is a notional item because you have holding the investment. It is not held for maturity. You are not going to sell immediately, so don't pay MAT on that, because sometimes this year the market value is showing huge and you would have booked so much of profit. But in the next year, it will fall like anything, and if you made that adjustment, our revenue will not be consistent. So with regard to the asset and investment in equity instrument, you don't pay the tax year on year basis. Pay the tax at the time of disposal, at the time of retirement, at the time of realization or otherwise transferred. At the end you adjust. அதுக்கு முன்னாடி adjust பண்ண வேண்டிய அவசியம் இல்லை. So what is the summary of whatever we have discussed till now, sir? You can classify the P&L item like this. Item reclassified to P&L, item not reclassified to P&L. If it is item reclassified to P&L, no MAT adjustment is required. Getting? Because அது automatic future என்ன ஆகும்னா reclassify ஆகும். Leave it. If the item not reclassified to P&L, MAT adjustments are required, my dear lovable students. For that, we are having exception. Number one, for this MAT adjustment required is having two exception. In the ரெண்டு விஷயத்துக்கு நீ MAT adjustment பண்ண வேண்டிய அவசியம் இல்லை. Number one, with regard to the asset, revaluation surplus of any asset. Revaluation surplus of any asset. Number two, equity instrument, investment in equity instrument. Investment in equity instrument, that is gain or loss or of investment in equity instrument. That gain or loss in investment in equity instrument, my dear lovable students, that gain, that loss, you don't pay MAT. Now you pay MAT at the time of disposal, retirement, transfer or otherwise. Brilliant, sir. So what 115JB subsection 2A and 2B is saying that three sections are there because it is Ind AS MAT. Ind, three sections should be there. 115JB subsection 2A, 2B and 2C. What 115JB subsection 2A and 2B is saying that 2A and 2B is 2A and 2B is saying that the adjustments, there are two adjustments are there. Number one, OCI adjustment and demerger adjustment. OCI adjustment, if you debited to P&L account and credited to OCI, that is P&L account debted to OCI should be added to the book profit. Yes, sir. Credited to P&L account and debited to OCI should be reduced from the book profit because for OCI we don't want MAT. Demerger adjustment, distribution of non-cash item or non-cash asset to the shareholders debited to P&L account should be added to the book profit. And now distribution of non-cash asset to shareholders credited to P&L account at the time of demerger reduced from the book profit. This is what 115JB subsection 2A and 115JB subsection 2B is all about. So we have critically understood that only the item that will not be reclassified to P&L will be taken into account. Exception to item that will not be reclassified to P&L. Adhikana exception, two exception. Exception to 115JB subsection 2A adjustment, revaluation surplus of any asset or gain or loss from investment in equity instrument designated at fair market value. Because the time of taxation for the above two exceptions are at the time of retirement or disposal or realization or otherwise transferred is what, my dear lovable students. So we are going to summarize this Ind AS MAT with the time of taxation. If you know this one chart, time of taxation, according to me, our Ind AS MAT comes to an end. Eppa tax panam. That's a very important slot, my dear lovable students. Yes. The other comprehensive income, OCI, includes certain item that will permanently be recorded in reserves and hence never be reclassified to statement in P&L, included in the computation of the book profit. So certain item will permanently transfer to reserve and it will never come to the P&L account. That item should be taken care because items not to be reclassified to P&L, that we have already settled. Following, these items shall be included in the book profit for MAT purpose at the point of time as specified below. 1, 2, 3, 4. 4 விஷயங்கள் நம்ம முடிச்சாச்சு. Number 1, changes in revaluation surplus of PPE and intangible asset as per Ind AS 16 and Ind AS 38. So with regard to the PPE, which is fixed asset, and intangible asset, sometimes you will make the revaluation. those revaluation surplus you don't included in the book profit on the year of the creation. It has to be included in the book profit at the time of realization or disposal or retirement or otherwise transferred. For example, I am having an asset which stands in the books at 1 lakh. I have revalued that asset with the permission of Ind AS 16 or Ind AS 38 for 25 lakhs. So 24 lakhs I have increased. If I am crediting this item, my dear lovable students, in the year of creation, if I have to pay MAT for this 24 lakhs, it will be very huge. Or you would have written down that asset. So what government is saying that revaluation surplus, there is changes in the revaluation surplus of PPE and intangible asset. That changes. Revaluation surplus level changes. Sometimes you would have already revalued, now you are changing as per Ind AS 16 or Ind AS 38. Or you may be revaluing for the first time. If it is revaluing for the first time anyway, you will not brought to the P&L account. You will pass an entry saying that asset account data to revaluation reserve, and you will keep that revaluation reserve in the liability side of the balance sheet. But for that increased asset value, you will provide depreciation. So depreciation will debit it to the P&L account, and the corresponding amount you will withdraw from the revaluation reserve and credit it to the P&L account. That is already taken care in the old adjustment, old MAT format. Getting it? Super, sir. But my dear lovable students, you would have already done a revaluation, but because of adoption of Ind AS is saying that this much revaluation is not required or more revaluation is required because Ind AS prescribing fair value accounting. So there is a change in the revaluation surplus of PPE and intangible item as per Ind AS 16 and Ind AS 38. As per MAT provision, no need to pay tax now. The time of supply or the time of taxation is at the time of the final withdrawal. And number 2, man, gain and loss from investment in equity instrument designated at fair market value through OCI, sir, Ind AS 109. For example, you would have invested in ANM Limited and now you are revaluing the value as per market value, fair market value. What? Through OCI, other comprehensive income, as per Ind AS 109. My dear lovable students, that item you don't tax now. You tax in the year in which to be included in the book profit at the time of realization or disposal or retirement or otherwise transferred. Remeasurement of defined benefit plans, Ind AS 119. Employee plans, employee benefit plans and all will be there. You would have remeasured that plan. Then to be included in the book profit every year as remeasurement gain or loss arises. This is not at the time of disposal. This is every year. Every year you have to include in the book profit. If it is plus means include in plus, minus means include in minus. Other than the 3 item, any other item to be included in book profit every year as a gain and loss arises. Other than these 3 item, sir, every year you have to make that adjustment. So 4 things are there. If you understand these 4 things, you are done with Ind AS MAT is what my opinion is all about. Number 1, changes in revaluation surplus of PPE and intangible asset. The point of taxation is not there of change but there of disposal. Gain or loss from the investment in equity instrument designated at fair market value. The point of taxation is not the time of revaluation. The point of taxation is the time of disposal or retirement. With regard to remeasurement, as per Ind AS number 19, you have to remeasure every year. Whenever you are making plus or minus, you have to make the plus or minus in the book profit also. Any other item which are not covered here, you have to make in every year. Brilliant to the core. I am moving into 115 JB subsection 2B and 115 JB subsection 2C. So till now we have talked is 115 JB subsection 2A only. Here it is all 2A only. We are moving into 115 JB subsection 2B and 2C. Now in a demerger, in case of resulting company, where the property and the liability of undertaken received by it are recorded at a value different from the value appearing in the books of accounts of the demerged company immediately before demerger, any change in such value shall be ignored for the purpose of computation of book profit of the resulting company. We know that in demerger 2 company will be there. Number one, the resulting company and the demerged company. All the assets and liabilities of the demerged unit will be transferred to the resulting unit. Am I right? Yes, sir. And this resulting unit have to record the assets and liabilities in the books of the resulting company. What 115JB subsection 2B is saying that if the resulting company is recording those assets and liability at a value other than the book value of the demerged company, I am repeating once again, if the resulting company is recording the assets and liabilities at a value other than the book value of the demerged company, then that income or short should be ignored. That profit or loss you don't take into account for the purpose of Ind AS MAT. So in a demerger, in case of resulting company, where the property and the liability of the undertaken received by it are recorded at a value different from the values appearing in books of accounts of the demerged company, immediately before the demerger, any changes in such value shall be ignored for the purpose of computation of book profit of the resulting company. So when you are calculating the 115JB of the resulting company, that profit or loss should be ignored. That means sometimes 1000 rupees is the book value of asset in the books of demerged company, but resulting company would have been recorded at 1200. On that extra 200, you are not supposed to pay MAT. Then 115JB subsection 2C. The book profit of the year of convergence and each of the following 4 previous years shall be further increased or decreased as the case may be by 1/5 of the transitional amount. Till now, I would have followed the normal accounting standard, but I become an Ind AS appliance company from this year, so I have to converge, I have to merge between the AS and the Ind AS. Because of that, both are following some different principle. One is following historical cost and the other is following the fair value accounting. So I have to make so many adjustments in so many ledger. So for the year of convergence, I have to make the transitional amount. So I'm bridging two systems. So some huge amount of difference will come. The entire amount of difference, if I am debiting to P&L account for that year, that is the year number 1, that the year of convergence, nakal hai. Or if the huge amount, if I am crediting to P&L account, automatically that year net profit will be increased and I am liable to pay more MAT. So what government is saying that difference, that bridging, you don't adjust at one time. You adjust at over a period of 5 years. So you have to make the 1/5 of the transitional amount. But this point number 1 and 2, we have to read it. However, the book profit of the previous year in which the asset or investment referred in point B to E below under the caption transition amount is retired, disposed, realized or otherwise transferred shall be increased or decreased as the case may be by the amount or aggregate of amount referred in the point B to E relatable to such asset or investment. If you are having any changes in surplus of asset, we have already discussed, and surplus from the investment in the equity shares through fair value adjustment, you don't make now, you make at the time of disposal. The book profit of the previous year in which the foreign operation referred to in point F below under the caption transition amount, this is the caption transition amount, we'll be reading, and after that we'll read this point again, is disposed or otherwise transferred shall be increased or decreased as the case may be by the amount or aggregate of amount referred in point F below relatable to such foreign operation. They are saying that if you are talking about the transitional amount, 1/5 of the transitional amount should be added back, or 1/5 of the transitional amount should be credited to the P&L account. Correct? So for that transitional amount, how to compute and what are the exceptions? That's what we are going to talk about. Transition amount. Transition amount means the amount or aggregate of amount adjusted in other equity excluding capital reserve, security premium on the convergence date but not including the following. This 1, 2, 3, 4, 5, 6. The 6th item should not form part of transition amount. Transition amount means the amount or aggregate amount adjusted in the other equity. நீங்க வந்து ஏஎஸ்ஐயும் Ind ASஐயும் கிளப் பண்ணுறதுனால வர டிஃபரன்ஸை நீங்கள் அதர் இக்விட்டியில் அட்ஜஸ்ட் பண்ணுறீங்க. எவ்வளோ ருபீஸ் அதர் இக்விட்டியில் அட்ஜஸ்ட் பண்ணணுமோ அதுதான் டிரான்சிஷனல் அமௌண்ட். பட் கேபிட்டல் ரிசர்வ் அட்ஜஸ்ட் பண்ணுறது கிடையாது அண்ட் செக்யூரிட்டி ப்ரீமியத்தில் அட்ஜஸ்ட் பண்ணுறது கிடையாது. அந்த டிஃபரன்ஸை நீங்கள் வந்து அதர் இக்விட்டியில் தான் அட்ஜஸ்ட் பண்ணமே தவிர கேபிட்டல் ரிசர்வ்லையும் செக்யூரிட்டி ப்ரீமியத்திலையும் அட்ஜஸ்ட் பண்ணக்கூடாது. But in the transitional amount, the 6 items should not form part. Number 1, amount or aggregate of amount adjusted in OCI on the convergence date, which shall subsequently be reclassified to P&L. If it is subsequently reclassified to P&L, and if you are adjusting through OCI, then why are you adjusting in other equity? So, adha neenga other equity la eduthuka koodadu. This is point number 1. Number 2, revaluation surplus of asset. In accordance with Ind AS 16 and Ind AS 38 adjusted on the convergence date, the time of taxation of these two items, revaluation surplus, is not today, it is the date on disposal. So, this item should also not be taken into account. The C part, gain or losses from the investment in equity instrument designated at fair value through OCI in accordance with the Ind AS 109 adjusted on the convergence date. Convergence date, if you are making gain or loss, the time of taxation is not now, the time of taxation is the time of disposal. Adjustment relating to item of PPE and intangible asset recorded at fair value deemed cost in accordance with the para D5, D7 of Ind AS 101 on the convergence date. If you are treating it as deemed cost concept will not form part of transitional amount. Adjustment relating to investment in subsidiary, joint venture, associate recorded fair value as deemed cost in accordance with the para D15 of Ind AS 101 on the convergence date. Basically, deemed cost items will not form part of transitional amount. This will not form part of transitional. An adjustment relating cumulative translation difference of a foreign operation in accordance with para D13 of Ind AS 101 on the convergence date. So, these 6 items will not be form part of transition amount. Number 1, sir, amount or aggregate of amount adjusted in OCI, sir, that will subsequently be reclassified to P&L. So, you have made some OCI adjustment that will be reclassified to P&L. That will be reclassified to P&L. Then anyway it is going to be reclassified to P&L. Why are you treating it as transition amount? Timing difference will automatically take care. Logic number 1. Then number 2, revaluation surplus of asset. Revaluation surplus of asset as per Ind AS 16 and Ind AS 38 is what the second discussion. Then number 3, gain or loss from investment in equity instrument. Gain or loss from equity instrument as per Ind AS 109 or amounts or adjustment relating to PPE or intangible items, sir, recorded at N value, fair value, recorded at fair value, deemed cost, fair value, recorded at fair value, deemed cost in accordance with para D5 and D7 of Ind AS 101. So, if you are recording the PPE and intangible as at a deemed cost, then that amount will not be treated as transition amount. Adjustment relating to investment in subsidiary, joint venture, associates. I would have invested in subsidiary, joint venture and associates. Recorded at fair value as deemed cost. That recording will not form part of transitional amount. And the last one, so I have invested in subsidiary, joint venture or associates as deemed cost will not form part of transition amount. Adjustment relating to cumulative translation difference of foreign operation. I may have some branch outside India, foreign operation. I may have cumulative translation difference, sir, as per Ind AS 101, that will not be treated as transitional amount. So, other than this 6 item, whatever adjustments you are making to bridge the AS and Ind AS, you will put in an account an amount called as transition amount. And this transition amount will be adjusted in the other equity excluding capital reserve and security premium. That is very important. Excluding capital reserve and security premium. Excluding capital reserve and security premium. So my dear lovable students, excluding capital reserve and security premium. So what is transition amount? Transition amount means the amount or the aggregate of amount adjusted in the other equity, excluding capital reserve and security premium on the convergence date, but does not include 6 things. Number 1, any adjustment you made in the OCI which will be reclassified to P&L. Number 2, revaluation of assets as per Ind AS 16 and Ind AS 38, gain or loss from the equity investment designated at fair value as per Ind AS 109, PPE or intangible asset you have revalued, that is at the recorded at the fair value as deemed cost in accordance with Ind AS 101, or the investment in subsidiary or joint venture or the what associates you have brought to the fair value as deemed cost, that amount, and the adjustment relating to cumulative translation difference of foreign operation. These items will not be taken into account as transition amount for the purpose of Ind AS adjustment. What is the year of convergence? Means the previous year in which the convergence date falls. The year in which the previous year in which the convergent dates fall is the year of convergence. And what do you mean by convergence date? Means the first day of the first Indian accounting standard reporting period as defined in Ind AS 101. So reporting period la எப்போ first day எந்த previous year la விழுதோ that year is called as convergent date. So under Ind AS, my dear lovable students, in preference shares is considered to be a liability, debt. As per the Ind AS, investment in preference shares, if you are investing preference shares, is considered to be a liability, that is debt, and the corresponding dividend expense is debited to P&L account as interest cost. However, for the purpose of computation of book profit under 115 JB, the profit or transition amount shall be increased by dividend or interest on preference share, whether presented as dividend or interest. That means as per the Ind AS, if you see, preference shares are treated as debt, and if you pay any preference dividend, that will be debited to P&L account as per the Ind AS concept. But for the MAT, for the purpose of computation of book profit under 115 JB, that amount shall be either increased by the dividend or interest on preference shares, whether present as interest or preference shares. In case of an assessee being a company where there is an increase in book profit of the previous year due to income of the past year or year included in the book profit on account of advance pricing agreement entered into by the assessee under section 92 CC or on account of secondary adjustment required to be made under 92 CE, the AO shall, an application made to him in this behalf by the assessee, recompute the book profit of the past year or years and tax payable, if any, by the assessee during the previous year under subsection 1 in such manner as may be prescribed and provisions of 154 shall so far as may apply, and the period of 4 years specified in subsection 7 of that section shall be reckoned from the end of the financial year in which such application is received by the AO. That means I would have already suffered MAT for earlier previous years. This is transfer pricing adjustment. I would have already suffered, sir, MAT for immediately preceding previous years. But what would have been happened? Sir, because of entering into advance pricing agreement under the 92 CC, or I would have, because of the secondary adjustments under 92 CE, my profit would have been increased. My profit would have been increased. So once there is a change in the reported net profit, I have to go and apply to the AO that, my dear AO, I have already filed the return of income, I have already suffered the tax, and earlier year I was used to travel through the MAT, or I would have traveled through the normal route. My dear lovable students, you have to go and apply to the AO requesting that please recompute by MAT. என்னோட மேட்டர் ரீகம்ப்யூட் பண்ணி கொடுங்க, because I have entered into an APA which was not there earlier, and we all know that once you entered into an APA it should be positive, correct? Rollback provision 4 back years, 5 front years, yes sir. So once you enter into an APA, go and request to the assessing officer saying that last year we have already calculated the MAT, but that MAT calculation is going a change, or now I made a secondary adjustment specified in 92 CE. Because of that secondary adjustment, my MAT calculation is going to change. Please make it a change. And he will treat that the previous year's computation as mistake apparent from record under section 154. And within 4 years from the end of the financial year in which the order sought to be rectified, he will rectify that order by applying section 154. Now you read it. In case of an assessee being a company, Kandipa for company only MAT provisions will be applicable. Where there is an increase in book profit of the previous year, last year book profit is increasing due to income of the past year or years included in the book profit on account of advance pricing agreement entered into by the assessee under section 92 CC, or account of secondary adjustment required to be made under 92 CE, the AO shall, on an application made to him in this behalf by the assessee, recompute the book profit of the past year or years and tax payable, if any, by the assessee during the previous year under subsection 1 in such manner as may be prescribed, and the provisions of 154 shall, so far as may apply in the period of 4 years specified in 154 subsection 7 of that section, shall be reckoned from the end of the financial year in which the said application is received by the AO. That means once the previous year's profit has been changed, then the assessee, because of the advance pricing agreement or the secondary adjustment, the assessee has to go and ask to the AO that please recompute my previous year's book profit, provided that provisions of subsection, this subsection shall apply only if the assessee has not utilized the credit of tax paid under this section in any subsequent assessment year under 115 JAA. Provided that this recalculation will be possible, only the credit that we'll be talking later has not been utilized. Provided further that provisions of this subsection shall also apply to an assessment year beginning on or after 1st April of 2020, and notwithstanding anything contained in any other provision of this act, no interest shall be payable to such assessee on a refund arising on account of provision of this subsection. That means you are not supposed to take it as a that adjustment, or you should not get any interest. If these two conditions are satisfied, you can go and ask the AO that please recompute my income. This is the structure of MAT for Ind AS company. You know one thing, now we are entitled to do the sums. We are having one example, we will read it. Company which adopt Ind AS with effect from 1st April 2016 are required to their financial statement for 16-17 as per the requirements of Ind AS. Such companies are also required to prepare an opening balance sheet as on 1st April 2015 and restate the financial statement for the comparative period 15-16. So, in such a case, the first time adoption adjustment as on 31st March 2026 shall be considered for computation of MAT liability for the previous year 16-17, that is assessment year 17-18 and thereafter. Further, in this case, 5-year period shall be previous year 16-17, 17-18, 18-19, 19-20 and 20-21. That is transition amount. No, the transition amount will be reckoned from previous year 16-17. What is the Ind AS MAT format? Format of computation of tax under 115 JB. Step number 1, net profit in accordance with the provisions of Companies Act or the relevant Act of Insurance, Banking, Electricity as the case may be, at adjustment contemplated in 115 JB, all the normal adjustments. IRS will get depreciated and reduce the tire. You will get a subtotal. Normal. Less adjustment contemplated under 115 JB, that is 2A, 2B, all those stuffs. Book profit computed in accordance with explanation 1 to section 115 JB. Till now, we have reached the normal. Till now, because here you are adding back and here we are lessing. Now, in case company is required to comply with the Ind AS while preparing the financial statement, following additional adjustment shall be made to book profit as computed in step number 1A. Book profit computed in explanation 1 to 115 JB, add adjustment contemplated. Items, sir, this where I am adding items credited to OCI. Credited to OCI means debited to P&L, not to be reclassified to P&L, should be added back. Except gain from changes in fair value of equity instrument through OCI and revaluation surplus from asset on retirement, disposal, realization on transfer. Puriyudu, sir. Gain from changes other than mentioned above, sir, these two things, these two are exception. The second adjustment to be added is amount debited to statement of P&L by way of distribution of non-cash asset to shareholder in a demerger as per Appendix A to Ind AS 10 as per 115 JB subsection 2A. 1/5 of the transition amount as per 115 JB subsection 2C should be added back. If that transition amount, 1/5 amount has been debited to P&L account because of that net profit would have been reduced, should be added back. You will get the subtotal. The corresponding whatever you have added back should be reduced. Less adjustment condemn later. Items debited to OCI. Items debited to OCI means credited to P&L account and not to be reclassified to statement of P&L, sir, should be reduced. It is having again two exceptions. Loss from changes in fair value of equity instrument, because gain we have covered there. So loss will be covered in the reduction side. Loss from changes in fair value of equity instrument through OCI and revaluation surplus from asset of retirement, disposal, realization or transfer, and loss from changes other than mentioned above. And amount credited to statement of P&L by of distribution of non-cash asset to the shareholder in a demerger as per Appendix A to Ind AS 10 115 JB subsection 2A, and 1/5 of transition amount. We have studied that what and all will form part of transition amount. Transition amount is the amount or aggregate of amount that we are going to be adjusting the other equity, but does not include in the two items. You should be able to recall what are the two items, and 6 items will not form part of transition amount. So 1/5 of the transition amount, if that transition amount is credited to P&L account, you have to remove it as per 115 JB subsection 2C. Now you got the book profit in respect of financial statement prepared in accordance with the Ind AS. Now we can easily find out the MAT liability on that book profit, apply 15% or 9% if that entity is situated in IFSC. That's it, game over. Now again, all the normal drama, that is, you have to calculate the total income as per the normal provisions of the act, apply 30% on that above in case if it is a domestic company, or 40% in case of foreign company. So that is a total tax liability as per the normal provisions. Then you have already calculated the 15% MAT, whichever is higher, add surcharge if applicable, and education says the total tax payable you will get. This is the ultimate format of, my dear lovable students, the MAT for Ind AS company. Basically, sir, you have to analyze any item will be reclassified to P&L, not to be reclassified to P&L. If it is reclassified to P&L, then leave it. Don't do any MAT adjustment. If it not be reclassified to P&L, you check it whether debited to P&L, credited to OCI should be added back. Debited to OCI and credited to P&L should be reduced. In that, two exceptions are there. The two exceptions are, sir, fair value equity adjustment, that is one adjustment, and number 2 is the assets revaluation, changes in the surplus of the revaluation assets. That will not be taken care now. It will be taken care only at the time of disposal. With regard to the second one, my dear lovable students, the second item is the distribution of non-cash asset to the shareholders at the time of demerger. If that has been debited to P&L account, should be added back. If that has been credited to P&L account, should be reduced, and 1/5 of transition amount. Sir, over a period of 5 years, you will make the transition amount. So once you have debited that transition, 1/5 of transition amount should be added back, and that amount should be reduced is what. Here, this is only analysis. We have already done all these things. Even the time of taxation, we have done PPE, all those adjustments. These are just analysis, and FAQs has been given. Frequently asked the question, my dear lovable students. This is purely Ind AS matter, man. If you want, you can read it. Otherwise, you can straight away skip it. There is no problem at all, because in examination, this FAQs will not be tested. This is only for our understanding purpose. Only the question will be asking in examination. I will be doing one question from Ind AS MAT. That part, that is a C category part. If you want, you can go through once. I have included in the material. That's it. BGR Limited is a company whose financial statements are prepared in compliance with Ind AS. The extract of statement of P&L for the year ended 31/2024 is given below. Statement of P&L of BGR for the year ended 31/2024. A revenue from operation 11,76,000 has been given in lakhs. Okay. Other income 37. This is the total income. Expenses, in that expenses, cost of raw material and component consumed, employee benefit cost, depreciation and amortization. Normally we will add back depreciation debited to P&L account, and depreciation excluding revaluation we will reduce. Finance cost, other expenses, they have given total expenses. Profit before tax, current tax, profit for the year, basically net profit for the year. So after finding out the net profit for the year only, as per the presentation, they are showing the OCI. In that OCI, two classification are there. Item that will not be reclassified to P&L. So this has to be taken care. Item that will be reclassified to P&L, ignore on face, no need of MAT adjustment. Total comprehensive income and other comprehensive income for the period, that means this plus this plus this. So OCI is a below the line item, my dear lovable students. Now I am going to analyze. Following additional details are available. Other expense include, here you are having other expenses. No, the details of the other expenses they have given. Provision for doubtful debts should be added back because diminution in the value of the asset. Provision for warranty unascertained liability should be added back because provision created for unascertained liability. Penalty for infraction of law, that is relevant only under the normal route, not relevant under the MAT route. Depreciation include depreciation from revaluation of asset to the tune of 96 lakh. So total depreciation and amortization 2396 should be added back. By excluding that amount, you have to reduce. Normal calculation of the MAT, that's it. Items that will not be reclassified to P&L comprises of, this 4 items are comprises. A reduction in post-employee benefit obligation on account of remeasurement of 4,345,361 lakhs. We have already studied the time of taxation. With regard to the reduction in post-employee benefits, you have to adjust every year. Gain from investment in equity instrument designated fair value through OCI. Sir, this you are not supposed to adjust now, even though the item will not be reclassified to P&L because the time of taxation is the year of disposal. Deferred loss on cash flow hedge. Deferred loss on cash flow hedge is an item which has to be adjusted every year. Surplus on revaluation of fixed asset, that will not be adjusted in the current year, it will be adjusted in the year of disposal. Item that will be reclassified to P&L, don't read it at all, ignore it. Compute book profit under 115 JB of BGR for assessment year 24-25 is a question. So computation of book profit as per 115 JB, net profit as per statement of P&L, which is already given. This is the net profit 238026. Okay, sir. Add, do as if normal MAT, whatever we know. Then come to the items that will not be reclassified to P&L. Then you have to take care of the demerger adjustment. Is very rare adjustment because only in the year of demerger that adjustment will come. And 1/5 of the transition amount, fine. Adjustment as per explanation 1 to 115 JB subsection 2. Current tax should be added back because income tax paid or payable. Super, sir. Provision for doubtful debt should be added back because diminution in the value of the asset. Provision for warranty, since it is an unascertained liability, should be added back. Depreciation charged to P&L account should be added back, and depreciation excluding revaluation should be reduced. You will get some subtotal. Super. Less adjustment as per explanation 1 to section 115 JB subsection 2. Depreciation other than revaluation of asset. Depreciation other than revaluation of asset is 2300 because totally you are having 2396, but out of that 2396 minus 96 now 2300 is a normal depreciation, so only the 2300 is allowed. So book profit computed in accordance with explanation 1 to 115 JB is 3,47,973. Now special adjustments contemplated. Special adjustments contemplated under 115 JB subsection 2A, 2B, 2C. In that 2A, remeasurement of post-employment benefit. You just think, read the adjustment, I will explain you the logic. Reduction in post-employee benefit obligation. That means you have created some obligation on your liability side of the balance sheet, employee benefit obligation. You have created, for example, 500 crores. I am saying an example. But because of the introduction of the Ind AS, what Ind AS is saying that 500 crores is not required. You need only 400 crores. So you are going to change 100 crores. So what you will do, you will debit the liability because you have created excess liability and you have credited that amount to the P&L account. You credited that amount to the P&L account. Now this 500 crores, how you have created? You have created by debiting the P&L account to employee benefit cost over the past years. In that year and all, since it was an ascertained liability, we have allowed you to claim it as a deduction. But now because of Ind AS scheme, you are saying that you have to reduce that item, that much provision is not required. So what ideally you should have done, you should have credited that element to the P&L account. But since your profitability will get adjusted, what you will do, you will be adjusting that item through the OCI account. So what is the position of the government? We have lost tax because you have debited that item in the earlier period. Now you are reversing that liability, but not through the P&L account, through the OCI account, and you are saying that permanently we are transferring that to the other equity. We will never bring back that to the P&L account. So if we miss the chance now, we will not get tax on it. So this is a reduction in post-employee benefit. You are reducing the liability. So liability account debted to P&L account, but you have not credited to P&L account. You have transacted through OCI. So this has to be manually added. Is what 115 JB subsection 2A, 2B and 2C is saying. So 45,361 should be added to the net profit. Whereas, sir, deferred loss on cash flow edge 3461. This is deferred loss. Loss means it should have been debited to P&L account, but you have not debited to P&L account. You have adjusted through the OCI, and my starting point is profit for the year only this much. That means this item has not been adjusted. So if that loss has been debited to P&L account, automatically, my dear lovable students, my net profit would have been reduced. Correct? And this item is not going to bring back to the P&L account because item not reclassified to P&L. So what government is saying that you can manually reduce it. So less deferred loss on cash flow edge as per 115 JB subsection 2A. So you will get the book profit for Ind AS company. On this apply whatever 15%. So penalty for infraction of law is not to be added back for computation of MAT, because that is not applicable for MAT. That is applicable only for normal route. Gains or losses from change in fair value of equity instrument through OCI and revaluation surplus from assets shall be given effect for book profit computation on retirement, disposal or realization of transfer only. That is not the time of taxation. Now, item in OCI that will be reclassified to P&L shall be ignored while computing book profit. With this, the question number 1, the basic question of the Ind AS MAT comes to an end is the call. My dear lovable students, what the Ind AS MAT is all about. Ind AS MAT is a very simple topic which may be expected for 10 mark in examination. What they are trying to say is P&L you have to analyze like this. P&L, bottom of the P&L, I show you one bottom of the P&L. Inside OCI, you will be having two item reclassified to P&L, item not reclassified to P&L. If the item is item reclassified to P&L, no MAT adjustment is required. If item is item not reclassified to P&L, MAT adjustment is required, but we are having two exceptions. Revaluation surplus of any asset or investment in the equity gain or loss should be ignored. 115 JB subsection 2A summarization is like this. You have to check OCI adjustment other than NSR demerger adjustment. OCI adjustment, sir, this OCI adjustment should be item what? Not to be reclassified to P&L account, because item reclassified to P&L we will ignore while calculating the matter. You have to check debited to P&L account, credited to OCI should be added back. Sir, debited to OCI and credited to P&L account should be reduced. That's it. In case of demerger adjustment, if distribution of non-cash asset to a shareholder debited to P&L account should be added back. Distribution of non-cash asset to shareholder credited to P&L reduced from the book profit. Fantastic to the core. Now, exception, we are having two exceptions are that revaluation surplus and gain or loss from the investment in equity instrument designated at fair market value. What is the time of taxation of that? Either at the time of retirement or disposal, realization or otherwise transfer. This one table plays a major role. Once you understood this table, that's it, game over, my dear lovable students. Changes in revaluation surplus of PPE and intangible asset to be included in the book profit at the time of realization or disposal or retirement or otherwise transferred. Gain or loss from the investment in equity instrument designated at fair value through OCI to be included in the book profit at the time of realization, disposal, retirement or otherwise transferred. Remeasurement of defined benefit plan to be included in the book profit every year as remeasurement gain and loss arises, or any other item to be included in book profit every year as the gain or loss arises is what the discussion is all about. So you take the net profit as per P&L account, do the normal adjustments. Whatever we have studied under explanation 1 to 115 JB subsection 2. Then you will get the subtotal. To that subtotal, my dear lovable students, you have to add or less special adjustments. Ind AS company, 3 adjustments will be coming. Only 3 adjustments will be coming. Items not to be reclassified to P&L under the head OCI has to be taken care. In that 2 items should not be taken care. Demerger adjustment should be taken care. Demerger adjustment should be taken care. And the last one, 1/5 of the transition amount should be taken care. How to apply or find out the transition amount? You have to take all the convergence adjustment except 6 adjustments are there. So this is a very easy topic. This may be a 10-mark potential area for examination, my dear lovable students. And in this list, we have to do more question. Once you understand question number 1, the remaining and all are a cakewalk. We will be doing with the question number 2. Illustration number 2 is there. We'll be solving illustration number 2. Don't worry about that much big. Illustration number 3. Once you understood up to this is a November 2018 question. Once you understood up to this, then that illustration number 1 and 2 and all is not at all a big matter. What I am saying to you at this point is revise the old math. That is a normal math provision. Redo 2 or 3 questions and study the special adjustment of the Ind AS MAT and do that 1 question. And in the coming slot, when you are doing the remaining 2 questions, my dear lovable students, you will be feeling so much comfortable in the math. And the math in special cases are very easy, 5 to 10 minutes we can knock it off. Math credit is another very easy part. Computation of total income under math route and normal route is again an easy part, my dear lovable students. So revision is the key to success. Take this as a block for 10 minutes for your examination, 10 mark for your examination. Revise this part properly on a cumulative basis, then move to the next part. Then the level of understanding will be very level. So in the coming slot, we will be completing, my dear lovable students, the remaining 2 more questions in the Ind AS MAT to say that we are done with the math. So revise it very properly. Do the sums instead of just seeing the sums. Sit and work out the sums. That is what very important. Some people will just look at the sums. Don't do that mistake. Especially all the computation related questions you have to sit and do. We'll meet in the coming session for next 2 more. Till that, thank you and bye bye from my end.